Welcome, investors and traders. In today's video, we'll delve into further bold predictions for 2024 and explore strategies to profit in the stock market by leveraging analytics, historical data, financial information, and technical analysis. I will examine each bold prediction individually and demonstrate how to capitalize them effectively. Then I will combine these bold statements and construct a weight of evidence approach to guide you through your investment decisions. Stay tuned as we navigate through these predictions and uncover opportunities for success in the market. By the end of the video, we will combine these indicators, these bold statements together to come up with a probability of succeeding. Before we get started, our history. In 2022, we announced on the YouTube channel too short everything from the stock market to Bitcoin to QQQs to the spiders to technology. In 2023, we officially went long on our recommendations, specifically on the Magnificent Seven. Both years, we had great years and can be tracked by just looking back at our videos. In 2024, we have been a lot more selective and predicting that the S&P 500 and the QQQs will be around up 8 to 10% by the end of the year. Before we get started, disclaimer, the information presented on our channel is intended for educational and informational purposes only. You should not be considered a substitute for professional financial advice. You need to build your own system, your own probability. The mantra for 2024, amidst predictions of a bear market or bull market, both will miss the mark this year. In 2024, success will hinge on stock selection, with most gains driven by a select few mega capitalized companies. If you find yourself in those companies or sectors, you are poised for a good year. As we told you, notably last year's significant gains were elusive for those not invested in the Magnificent Seven. Bold statement number one. Typically, in bull market experiences, there is a 5% pullback around 4 times annually, with a 10% correction occurring once a year. In a typical bull market cycle, which is categorized by rising stock prices and overall optimism in the market, it's common to experience periodic pullbacks and correction. These serve as a natural adjustment to the market's upward trajectory and allow for healthy consolidation before resuming the upward trend. A 5% pullback refers to a decline in the stock market prices by 5% from its recent highs, while a 10% correction indicates a more significant decline of 10%. These pullbacks and corrections are normal occurrences within a bull market and provide opportunities for investors to reassess their positions, take profits, and potentially find new entry points. So what are we doing? This is not last year where the market went straight up. There will be pullbacks. We still consider ourselves in a bull market, not as powerful as last year. Typically on these bull markets, there will be 4 times 5% pullback and 1 time a 10% correction. Our first bold statement is every time that there is a pullback of 5 to 10%, you buy into it. To further on our bold statement, when we get to about 8 to 10% profits, you take the money off the table, because we feel this will not be like last year where we keep continuing to go upwards. 5% pullback, 10% pullback, buy. You make anywhere from 5 to 10%, you take your profits. Statistically and probability, we're speaking about this 5% and 10%. Further prove my point, a picture is worth 1,000 words. On 12/31/2023, we close on the QQQs at 409.52. If you take 10%, it's 450 and 472. On March 21st, we reached a high of 449.34. We announced on January 1st that we would have swings from 0 to 10% in the initial 4 months posted on a video. We reached this number close to $1 difference. And then once we hit the 10%, we went to the low on April 19th of 413.07, about 1%. off the close of 12/31/2023. And then we had a rally up to posting this video of 440. So you see how using this 0 to 10% this year has worked very well. And we expect the same thing to happen again this year. Pullbacks of 5% and the worst case scenario, 10%. Bold statement number 2. The market is poised to rise by 8 to 10% this year, which was bold statement number 1. Bold statement number 2, will be driven by the dynamics of the presidential election cycle. Historical analysis suggests that in the 4th year of a presidential term, the market tends to experience an average increase of 8%. This pattern is attributed to various factors, including increased government spending and generally positive economic outlook as administrations seek to bolster their performance ahead of elections. Additionally, the market often responds positively to the certainty provided by the conclusion of the election cycle, regardless of the outcome. This anticipated growth presents opportunities for investors to capitalize on the momentum of the market and potentially achieve significant returns. Further bold predictions revolves around the multitude of elections taking place globally. Approximately 40 countries have had or set to hold elections this year, with of course the United States being one of the most influential, also gearing up for its election. The elections are anticipated to bring about a major policy changes and increase geopolitical friction extending from Washington, D.C. to Taiwan. This year marks a historical high in the number of elections worldwide, with 41% of the global population set to cast their votes. The economic impact is substantial, affecting a staggering 44.2 trillion of GDP. Additionally, elections are on the horizon for the European Parliament, adding another layer of significance to the global political landscape. Stay tuned as we explore the potential bullish outcomes tied to these elections and their ramifications on the world stage. Understanding why this year is expected to be bullish on a global scale involves delving into the presidential election cycle theory developed by Yale Hirsch, the founder of Stock Traders Almanac. This theory posts a predictable pattern in equity market returns during each new U.S. presidential term. According to the theory, U.S. stock markets typically exhibit weaker performance in the first year of a presidential term. They will also have a poor second year. Subsequently, they recover and reach a peak in the 3rd year, and the final year is not as good as the 3rd year, but is still the 2nd best out of a 4-year period. This cyclical pattern then restarts with the commencement of the next presidential election. The election cycle theory is based on the idea that the shifts in presidential priorities exert a significant influence on the stock market. It suggests that markets tend to perform optimally in the second half of a presidential term when the incumbent president aims to stimulate the economy for re-election purposes. Historical data from the past several decades appears to support the notion of a stock surge during the later half of a presidential term. However, it is always good to combine this indicator with other indicators. Bold prediction number 3. A news story is anticipated to emerge, triggering substantial gains in the stock market within a single day. This story is expected to continue to influencing the market positively for the next few months, propelling overall indexes higher. The nature of the news story could range from positive information about the semiconductor industry to favorable updates about the upcoming presidential election or any other impactful news. The mass media is projected to amplify and build upon this information, contributing to sustained market momentum. This phenomenon underscores the market's sensitivity to significant developments and the media's role in shaping investor sentiment based on emerging narrative, with many fundamentals and many other factors pointing to a bear run earlier than what I expect. Many positive news stories will be triggering a bull run in the remaining months of this year. Bold prediction number 4. While there may be bearish sentiment among some fundamentalists indicating the market should trend lower, it's important to consider the broader context and market dynamics before making decisions. Bold statement suggests that while there may be valid reasons for concern, such as economic indicators or geopolitical uncertainties, the timing for entering into a bearish position is not imminent. This will be due to several factors. Market resilience. Despite potential concerns, the market has shown resilience and not yet exhibited signs of significant downturn. The resilience could be attributed to various factors such as robust corporate earnings, supportive monetary policies, or investment sentiment. As the time of filming, utilities, healthcare, combined with technology, has given a broad rally to the S&P 500. Forward-looking outlook. Market participants will be looking ahead to potential catalysts or events that could drive future market performance. This forward-looking perspective could influence decision-making and suggest that any bearish trends may not materialize in the immediate future. With this positive event that we're saying in bold statement number 3, they will force the short sellers who are not using a weight of evidence to have to cover their positions and buy it back. Technical indicators, technical analysis tools indicators are not all signaling a clear bearish signals at the present. As we know, an overbought market can quickly become much more overbought. We believe in our bold statement that this year will be bullish, but next year will be bearish. Next year, we will be shorting the market like it's 2022. Putting it all together, market projections. Statistically, the projection indicates that the indexes will likely express an 8 to 10% increase this year. This estimation is based on historical trends and influence of the presidential election cycle, which typically sees market gains. Volatility expectations. The statement acknowledges the likelihood of increased volatility due to uncertainty surrounding the presidential elections. Such events often induce fluctuations and unpredictability in the market, creating both risk and opportunities for investors. Buying strategy, not shorting strategy. In the light of the anticipated volatility and potential pullbacks, the statement suggests that buying on the dips could be high probability choice for investors, particularly for those who are new to the market or profess less selective approach to stock picking. They can buy the QQQs and the spiders, knowing statistically we are up 8 to 10%. Statistically, we will have 4-5% pullbacks, 1-10% pullback. For those who are more sophisticated, finding the selective stocks that are going up could lead to even more gains than the 8 to 10%. Do not forget, we are preparing for next year. Looking ahead with our bold statement number 5, we will have a down year next year. So we know this bull market is in the 9th inning, but not just yet. We've seen many times where something overbought can get a lot more overbought for months. You know the catchphrase: study it, analyze it, adapt it. Emphasize the importance of diligence, research, and flexibility in navigating the complexity of these financial markets. If this video is useful for you, please like and subscribe, as the next video will go over market overviews and also a few good stocks to buy on the pullbacks.